Hello and thanks for joining us. I'm Michael Goldberg. I am Managing Director and Portfolio Management Manager at Collins Street Asset Management. And I thought today we'd have a bit of a chat about our flagship fund, the Collins Street Value Fund, a little bit about our process, a bit about our philosophy, what makes us different, and what's really driven our returns over the journey so far. Now, with respect to the disclaimer on the screen at the moment, I think it's probably worth pointing out two key points. Number one, we are a wholesale-only fund, so our investors do need to qualify as sophisticated. If you don't know what that means, or you'd like a little bit more advice, we're happy to take your call. Our contact details will be available at the end of the presentation. I think the second thing worth pointing out is that this is not a conclusive or complete coverage of our fund. If what we discussed today is of interest, again, please feel free to reach out to myself or Rob, our Head of Investor Relations. We'd be happy to walk you through our IM and have a conversation. Now, before we get into the nuts and bolts of our philosophy and process, I think it is worth calling out our view on, or our approach to investing other people's money, and also to briefly talk about the sorts of investor that might find value in investing in the Collins Street Value Fund. So to start off with, I think it's important to call out that we are not a get-rich-quick scheme. The vast majority of our investors are already financially comfortable. They've spent a lifetime building businesses, they've spent a lifetime building property portfolios, or just generally building up their wealth, and they're coming to us for a considered approach to investing in shares to provide a diversification for themselves. Certainly for themselves and for their own benefit, but also, as often as not, it's for the next generation, for their children and their children into the future. Because that is their core consideration, because so many of our investors are looking to maintain and build wealth gradually over a long period of time, capital preservation tends to be first and foremost in their minds, and so it also needs to be first and foremost in our minds. Now, how that manifests throughout our philosophy and process, we will certainly cover off. It also manifests through our portfolio construction. Now, with respect to how we view ourselves and the importance of aligning our interests with our investors, we think one of the very first steps that any manager of money or anyone who's been entrusted with money is to ensure that our interests are aligned with our investors' interests. From our perspective, we see all the time when we're investing in ASX-listed companies that directors and managers will have come up with some wonderful scheme for their incentive scheme, some arbitrary assessment of what adds value. So where us as investors are concerned about return on investment, or we're concerned about the strength of the balance sheet, or we're concerned about an improving share price, oftentimes directors will be remunerated for a product rollout or for growth in revenue. And too often we've seen managers sacrifice our best interests for their best interests, and unaligned interests are almost a guarantee of unfortunate outcomes. That's not to say per se that aligned interests are a guarantee of good outcomes, but you can be darn sure that if you've aligned your interests with the people who are looking after you, you'll get better outcomes on average over the long term. With respect to our track record, I don't want to spend too much time on this particular slide, none the least because past performance is no guarantee of future outcomes, but I think it is worth pointing out that our process, our approach, our focus has generated some best of peer returns over the journey, both over the 1 year, 3 year and 5 year. We've been recognized by both Morningstar and Mercer for our good returns. I think what's especially interesting is that some of our best performance, certainly some of our best outperformance, has actually occurred during periods of market volatility and weakness from the general markets. Just as an example, most recently in January 2022, when the market was down 6.5% or thereabouts, we actually managed to generate a positive outcome. Now, I'm not sure quite what that suggests, but I suspect that it speaks to the approach we take to picking the companies that go into our portfolio. I suspect it speaks to our portfolio not being representative of the broader market, and I think it speaks to our approach and consideration for capital preservation in general. I think it's probably also worth noting how we differentiate ourselves. Obviously, if we're achieving these different sorts of outcomes, it can probably be accounted back to the different approaches that we take to our investment journey. First and foremost, I think it's worth calling out that we only invest in companies we want to own. We're not driven by some mandate to own 100 different companies or have specific sectoral exposure. For us, if we are not absolutely enamored, if we don't absolutely love a stock, we simply won't invest in it. Secondly, I think it's worth calling out that we view ourselves as investors, not speculators. Now, that's certainly not to say that there's anything inherently wrong with speculating. Certainly people have made money out of speculating. Certainly it can be fun to speculate. But I think for us it's very important to, number one, distinguish when we're looking at a company, whether we're investing or speculating. And number two, recognize that our mandate is to invest and not to speculate. So while there might be a place for speculating, it's certainly not within the Collins Street Value Fund. I think as well, and we've discussed, the alignment of interests, I think, sets us apart from many of our peers. For instance, one way we align our interests is by having a zero fixed management fee. If our investors don't profit, we simply don't get paid. And the other key way that we align our interests really is by investing alongside as investors in the fund. So positive outcomes for our investors are positive outcomes for us and vice versa. Finally, the key point of where we might differentiate ourselves from others is that we're unconstrained in where we find value. Oftentimes, we'll get questions like, what box do you fit in? What sectors will you invest in? How big does a company have to be, or how small does a company have to be before you invest in it? And I think pigeonholing oneself into a specific sector or a specific market cap bracket really just does a disservice to that investor and any investors that are investing alongside those people. So from our perspective, we're happy to invest in industrials. Obviously, that is the natural stomping ground for value investors, but we're equally happy to invest in technology stocks, in commodity stocks. Wherever we can find value, we are happy to invest there, almost irrespective of the market cap size of those businesses. With respect to our philosophy, we do like to keep things simple. Essentially, what we're looking to do is buy $1 worth of assets or $1 worth of earnings for 50 cents. To be able to find these ideas where you can buy $1 for 50 cents, I think the key is getting comfortable being uncomfortable. Now, whether that means getting comfortable being uncomfortable with our process, perhaps getting out from behind our computer screens, going and asking the tough questions of management, going and doing some due diligence in areas that perhaps other people feel uncomfortable going to, or if it means investing in sectors or businesses or companies where people are generally uncomfortable with those sectors and businesses. In either event, if we can get comfortable being uncomfortable, we certainly can find significant opportunity. I think when push comes to shove, all we're really trying to achieve, all we're really trying to do is to just that little bit more than the next guy, in search of what we call an information advantage. Because if you can achieve an information advantage, you can very easily translate that into a performance advantage. Now, it doesn't just stop there. Once you've gone through that process and you've identified a good quality business, I think the key, perhaps even linchpin to our philosophy, is that we invest with conviction. As I previously said, we're not looking to own a diversified portfolio. We're looking to buy our favorite, most high conviction ideas. And I think if we've identified these businesses, and we've gone to the trouble to identify these businesses, we want to make sure that once we buy our position, it can have a meaningful impact in our broader portfolio. So as a rule, within the Collins Street Value Fund, once we've identified one of these businesses, we tend to put between 5 and 10% of our investable capital into that idea so that when it does inevitably pan out, we're able to benefit in a meaningful way. I think similarly with respect to our process, we try to keep it pretty simple. We're not looking to reinvent the wheel. Essentially what we try to do is we try and look at it as if we were looking to buy the whole business. So much like you would look at the financials and visit operations and test products if you were looking to buy a whole company, when it comes to buying a share of that company on the equity market, we look to do the same sort of thing. Now, certainly every company is going to be different, and so the process that you go through for each of those companies is going to look differently, but we look to put in the best effort we can to get that information advantage. And I recall a few years ago, we were looking at a business that offered a hair product that promised to thicken and regrow your hair. And as part of our process, even though they had studies indicating that it did work, we went and we bought 10 cases of the product, distributed it to my follically challenged family members, and for the next couple of months, every fortnight, the members of my family would provide me with a report on how they were going with that product. As it turned out, the product was actually pretty good, but for other reasons, we didn't invest in that business. A little bit different, companies like The Reject Shop, Metcash or Retail Food Group, which is one that we currently hold, our process will again be different. For those companies, we visited operations, we talked to managers, we talked to customers, we taste their delicious food. We'd do whatever we could to get a sense of how things were going on the coalface so that we can get an advantage of what the market appreciates or recognizes. Because oftentimes what you'll find is, if you're able to find out what's happening on the ground, you're actually 6 months ahead of what the market actually knows. With companies that are larger, better coverage, things like ANZ, one of our first investments in the Collins Street Value Fund, the process will be different again. There's not a lot of value turning up to the local Collins Street or Burke Street branch and asking some pointed questions to the teller. Certainly if I started asking about their customer flow or how much cash they've got in the till, I'm probably not going to get the sorts of outcomes or responses that are going to be beneficial to myself or the fund. The next slide gives you a good sense of our portfolio positioning, and as you can see, we're not really concerned with having the same sorts of weightings as what the market does. Instead, as we've said, if we find a good idea, we're happy to invest in it, almost irrespective of what sector it's in. I think the one point perhaps worth making on this graph, I think most of it is self-explanatory, except for special situations, which currently represents about 8% of our portfolio. And at the moment, that's represented by a couple of convertible notes that we've been able to negotiate directly with management of these listed companies. We really like convertible notes because they give us the ability to have equity upside while having debt-like downside. Similarly, our current holdings, as you can see on the screen at the moment, again, indicating that we're not really bothered by which sector we invest in. We're not even really concerned about how large the companies are that we invest in or how small the companies are that we invest in. We've really only got two considerations. Number one, can we find value within that business? And number two, given that we are a liquid fund, can we find the liquidity to both get in and to get out? Now, oftentimes you'll have to find enough liquidity to get out within the market, but sometimes companies themselves will create these liquidity events which will allow us to buy businesses that we otherwise wouldn't if we then had to go and sell them within the market. And that brings us to the example, which I hope will add some color and elucidate some of the discussions that we've had up until this point. And the company is Beach Energy. Beach Energy and really the oil and gas sector is a space that we've been interested in for quite some time. But when back in 2021, we found Beach Energy falling from about $1.80 down to $1.20, and then in August falling back down to about $1, we got really excited. Essentially, our view was that the market had wiped off almost 50% of the market cap of this business for a production downgrade of just 5%. Now, our view was that that was an emotional overreaction to what was going on. And so over the next couple of months, in August and September of 2021, we were able to build up a significant position in Beach Energy at around about $1.05 at the time where we thought it really was worth, its intrinsic value really was worth about $1.80. You know, we look at it from a high level. This is a company, it's a quality business with good management, a strong balance sheet, trading on a price to earnings ratio of about 5 times, I think it was at the time that we were doing our purchasing. You know, a company with some significant growth potential out of LNG in their joint venture with Mitsui, which will pay dividends in 2023. And a company that was trading at about half the valuation of its major peers on an earnings and production basis. But it wasn't just that Beach looked interesting as a standalone because it was a cheap company, but it also had a second tailwind. The second tailwind for Beach is really a sectorial tailwind. Now, there seems to be a growing dislocation between demand, supply, and fossil fuels in general, but specifically in oil and gas as well. Now, this is not the reason we bought Beach Energy, but it's certainly something that could make things very interesting for the sector and Beach over the next 5-10 years. You see, oil and gas demand is actually expected to increase well into the 2030s, even as supply comes off now in anticipation of an eventual decrease in demand. So you've got this really interesting confluence of factors at the moment, where due to political and social considerations, banks are making it almost impossible to get funding for new projects. You know, within the sector, you're seeing a consolidation with the likes of Oil Search and Santos having just recently announced that they were merging. And at the peripheral of the sector, you've got the likes of BHP, who traditionally have had energy-type projects, now selling those energy-type projects to the likes of Woodside Petroleum. So you've got this situation where you've got weakening competition, you've got an increase in demand, and you've got funding problems for new projects. Now, I don't know where this is all going to land. And certainly the situation is far more complicated than my brief explanation allows for. But if we're taking out the natural braking mechanism of new competition for the cycle of prices, it's certainly going to be very interesting over the next 5 or 10 years to see what happens with fossil fuels in general and oil specifically. So with everything that we've seen from Beach Energy and the industry since we first invested in it, you know, we're quite happy with our position. We tend to think that based on current situations, that Beach Energy really should be worth north of $2. We think that once the market recognizes that the price is where it is based on emotion and short-sightedness, I think once the market gets a sense of recognizing that the economics of the project are more important than how investing in the project makes you feel, that investors in Beach will do quite well. that brings us towards the end of this presentation, and I think if I could leave our investors with one message for their personal investment journeys, it would be have a process. It doesn't need to be complicated, it just needs to be thought through, and it needs to be repeatable, because at the end of the day, having a process really is the first and perhaps the best defense we can have against emotional decision making and investing in companies based on emotions, because long-term success in investing doesn't come from big swings or from lucky breaks. It comes from making smart decisions, considered decisions, again and again, time after time. So that really is, as far as I'm concerned, one of the keys to long-term investing success. Now, if what I've said to you is of interest to you and you'd like more information about the Collins Street Value Fund, whether you're thinking about investing now or perhaps just want to get a better sense of what we do and how we do it through our IM or through our quarterly reports, where we do a deeper dive into our thinking and our philosophy in our businesses and our companies, please feel free to reach out to Rob Hay or myself. Our details are available on the screen at the moment. You can also, of course, contact us via our website at www.csvf.com.au. I'd also note that we are available via IDPS on platforms like PowerApp, NetWealth, Hub24, and Mason Stevens. I certainly look forward to hearing from you soon, and bye for now.